Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate documents to see what is really going on behind the shiny press releases. And today we're diving into a filing that has got Trailblazer Merger Corporation, in a bit of a pickle, but also hoping for a big turnaround. Alright, so what is this filing we're looking at? It is a Form 8K, which is basically an announcement of major events that shareholders should know about right away. Think of it as the company's live blog for really big news. And Trailblazer Merger Corporation has some pretty big news to report. First off, they've got a little financial housekeeping to do. The company announced an amendment to a promissory note. Now that might sound a bit dry, but what it means is they've increased the amount of a loan they have from Trailblazer Sponsor Group LLC. This note went up by $250,000, bringing the total to a hefty $4,580,000. This is a pretty significant chunk of change to be borrowing, and it tells us the company is needing to fund its operations or a potential business combination. Now here is where things get a bit more tense. Trailblazer Merger Corporation received a notice from Nasdaq. This notice is about the company's market value of listed securities. Nasdaq has thresholds that companies need to meet to stay listed on their exchange. For the Nasdaq global market, a company's market value needs to be at least $50 million for 30 consecutive business days. Trailblazer has unfortunately dipped below that threshold for quite some time. So what happens now? The company has been given 180 days, which is about 6 months, to get back above that $50 million mark. This is called the MBLS compliance period. To get back in good standing, they need their market value to stay at or above $50 million for at least 10 business days during this period. If they can't manage that, they might be able to move their listing to the Nasdaq capital market, which has lower requirements. But if they fail to meet even those by the end of the period, Nasdaq will start the process to delist their shares. This is a serious situation as it can make it harder for investors to buy and sell the stock and impact the company's reputation. But it is not all doom and gloom for Trailblazer. They're also working on a significant business combination, which is essentially a merger. To give themselves more time to get this deal done, they've extended their business combination period. The deadline for them to complete this merger was extended from the 30th of November 2025 to the 31st of December 2025. This extension was funded by depositing over $11,000 into their trust account. This tells us the company is committed to making this merger happen. So what is this big merger? Trailblazer Merger Corporation, which we can call parent in this context, is merging with another entity. The plan is for parent to merge with a subsidiary holdings, and then that combined entity will merge with Cyabra Strategy Limited, which will become a wholly owned subsidiary. After all this is done, parent will be renamed Cyabra Incorporated. This means Trailblazer is basically becoming a new company called Cyabra Inc., focused on what Cyabra Strategy Limited does. The company is really pushing investors to look at the filings related to this merger. They filed a registration statement on Form S-4, which includes important documents like a preliminary proxy statement and prospectus. This is where shareholders will get all the details to vote on the merger. They're also pointing people to their previous annual report on Form 10. K for more information on directors and executive officers and their interests. Now, like most companies these days, Trailblazer is including a lot of what they call forward-looking statements. These are basically educated guesses about the future. They're talking about anticipated benefits of the merger, the expected timing of the merger, and how the combined company will perform financially. It is important to remember these are not guarantees. Many things can happen in business that are out of anyone's control, which could change these future expectations. They're very upfront about the risks involved. One of the key risks they highlight is their ability to maintain the listing of their securities on Nasdaq. This ties back to that market value issue we discussed earlier. They also mention the risk that the transaction might not be completed in a timely manner or at all. This merger is not a sure thing, and there are many hurdles to clear, like getting shareholder approval and satisfying all the conditions of the merger agreement. Finally, there is a disclaimer saying this report isn't an offer to sell or buy any securities, and that any offering will happen through a proper prospectus. This is standard legal language to make sure they're following all the rules. In essence, they are saying this is an announcement, not a sales pitch. So looking at this filing as a whole, we see a company, Trailblazer Merger Corporation, that is heavily involved in a significant business combination that will essentially transform it into a new entity, Cyabra Inc. They're actively managing their finances by taking on more debt through a promissory note amendment to likely fund ongoing operations or the merger itself. However, they are facing significant challenges with their stock market performance, evidenced by the Nasdaq delisting notice. This creates a duality in their situation. On one hand, the impending merger with Cyabra offers a potential path to growth and a new future. But on the other hand, the immediate pressure of meeting Nasdaq's listing requirements and managing existing debt is a serious concern. Their success hinges on successfully completing the merger and simultaneously demonstrating to Nasdaq that their market value is sustainable. If they pull off the merger, they might just be able to solve their Nasdaq problem through the increased investor confidence that a successful business combination can bring. But failure to do so could mean a delisting, which would be a significant blow. The key is whether the market will recognize the value of Cyabra and reflect that in Trailblazer's stock price before the compliance deadline. What is your take on Trailblazer's situation? Do you think they can pull off the merger and regain Nasdaq compliance? Let us know in the comments below. If you found this breakdown helpful, give us a like and subscribe for more deep dives into corporate filings. And as always, join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next one.